Welcome to the Euromines podcast. Today with us is Bryan Bille from Benchmark Minerals Intelligence. You are heading the geoeconomic and geopolitical section of Benchmark Minerals, right?
Yes.
Today we'll talk about raw materials prices, and we will talk about geopolitics in these exciting times, with the US doing a lot of things, with China doing some other things, and Russia also being put into the mix. Bryan, what is your role and what is Benchmark Minerals Intelligence doing?
Yeah, thanks, Florian. Thanks for inviting me. Yeah, so I am leading Benchmark's geoeconomic and policy coverage, basically bridging the gap between the market intelligence sides and the policy sides. And one of my responsibilities is tracking the geoeconomic and policy developments on the supply chains, various energy transition supply chains that we cover, amongst others, critical minerals, batteries, and electric vehicles.
So you're providing a lot of market intelligence to your subscribers. You're also organizing events. Giga 2025 just happened a few weeks ago. What was your impression how the policy discourse has changed in Europe?
The previous Giga Europe was organized in Stockholm. And from 2024 till now, I think a lot has changed. The geopolitical landscape has changed a lot with, of course, the Trump administration starting in January. So obviously geopolitics and policy with the Commission and the European Union having tabled so many policy initiatives, geopolitics and policy was front and center of Giga Europe. So there are a couple of takeaways, in my view. Happy to discuss them. But as a start, I think people talked a lot about the changed geopolitical landscape with the US, China, but also the many policy initiatives that the European Union has tabled recently.
So what was the more defining factor in these discussions, according to your opinion? Was it the US or was it rather China?
I think a bit of both, but can't deny that we've been through the last 10 weeks since January. I think we went through a geopolitical shock coming from the US. We're still, I think, a big caveat in all of this. Now the US is attempting to do a big major retreat from climate commitments, clean energy commitments. We'll still need to see what will that mean in terms of policy changes impacting the supply chains. But I think the movements there are sending or has sent a couple of big signals that were discussed during Giga Europe. And I think one of the major takeaways for me is perhaps the changed attitudes towards China. China was was the big elephant in the room during Giga Europe. That had to do also with a couple of, again, policy initiatives that the US tabled, and the fact that the EU is considering to change its approach to China in terms of investment conditions, because, in terms of decarbonization, de-risking, you need to, our view, need to do some trade-offs, because, China is very dominant in the space. China has already invested and is investing in Europe. So I think now there is a shift saying, or with the EU saying, look, we are in fact open to business as before, but perhaps potentially on the different conditions.
I was there also at the event. China was much more called out for, was my impression. So we often tend to compare ourselves to China. I think the US comparison would be much, much more interesting. And I wanted to hear your views on this executive order that Trump signed on the mining industry that was largely under the radar of media. Is this part of the crusade the administration is leading against climate change? Is it rather an issue of self-sufficiency? Where do you locate this? And how did markets react on that one? Do you have already an insight?
Yeah, perhaps it's stayed on the radar in Europe, but in our, I would say, sphere or space, it was big news. We saw this coming. I would not call this a crusade. I would just perhaps call this, or perhaps frame this as mining or critical minerals used in a national security background, because I mean the executive order, to summarize, is the Trump administration wants to bolster domestic critical mineral production, is using a national security imperative, as I think the Biden administration was doing, but now the Trump administration is doing it a lot more. So he's enhancing this, using emergency powers, and is aiming to bolster domestic production, mainly mining and processing, through a couple of policy levers, basically mobilizing and using existing funding mechanisms, but repurposing them. I think a nice one to watch is the revamp of the development finance, so DFC, the Development Finance Corporation tool, and the emergence of a fund. That, of course, there is the big issue of permitting. So the Trump administration aims to streamline that. I think the US has one of the longest permitting timelines in terms of for mining. And then the third one is so incentivizing offtakes through the role of the government. So basically a coordination of bidding, coordinating a bidding process. So these are a couple of levers that the Trump administration aims to use. But in the end, what is the demand signal that it is sending? That's perhaps a bigger and then a more important question. I mean, they're putting a lot of emphasis on mining, on the upstream side of the supply chain, and as you know, much less on the downstream side of the supply chain. As you know, I mean, the Trump administration aims to roll back parts of the IRA, parts of the bipartisan infrastructure law. So I think a concern could be, okay, what will be the demand drivers of all this? Potentially critical minerals will be used a lot more for defense applications, but in the end, you will need demand drivers. So I think there are a couple of things to keep in mind relating to the executive order. And one last thing, I mean, in our view, the permitting angle is very important. And despite the Trump administration aim to streamline that, given the litigation-prone nature of mining, there will still be a lot of hurdles, potentially, to solve this in the US.
So there's a lot of information now to unpack here. I have a few follow-up questions. First things first. So we know the US is quite rich in copper and in lithium. Do you think that we will see some changes then in the global market, in the availability of these minerals coming up because of this order? And my second follow-up question is, how would you compare the European Critical Raw Materials Act and the policies around it to it?
I mean, one thing that perhaps I forgot to mention is the narrative of the executive order, but also the aim of the administration is domestic supply. So I named the DFC tool. Before, DFC was used a lot, but quite significantly in a couple of to fund foreign critical mineral projects in Africa. Now, according to the executive order, that fund that will be created through the DPA, the Defense Production Act, so the Department of Defense and DFC, that will primarily be focused on funding domestic projects, despite the US facing supply deficits for graphite, cobalt. So I think that's an important thing to underline. Regarding, what will that mean for domestic production? I think I will use copper as an example because copper is an important one, has also been now included in the scope of the executive order. But again, despite the US having copper deposits, a lot of copper projects, so potentially a lot of copper supply, it's made and there are a lot of, a big stumbling block to all of this is permitting. So solving this permitting issue will be paramount to increase the supply for minerals like copper, basically. So that's, I think, one of the takeaways. Comparing this to the CRMA, it's not that easy. I mean, again, in my view,
certain elements are quite the same, or it's very similar. And would like to have joint purchasing, this kind of supply push, not so much on the demand side to the focus.
Yes, but at the same time, the CRMA is focusing also a lot on non-EU supply. And we talk about, I think, the strategic project a bit later. But, I mean, if you want to meet certain targets, also for the EU, you will need foreign supply from strategic partner countries, from other countries, to meet demand for batteries, demand for EVs. So that's now a bit more lacking in the US policies, critical mineral policies lately. That's present now in the Critical Raw Materials Act. And on the funding side, I mean, you probably know that better than me. I mean, the EU has a lot of initiatives, a lot of funding mechanisms. So I guess now the aim of the US to put everything in one fund, I mean, according to the executive order, could be a good thing, because then you've got a one-stop shop funding mechanisms to back those domestic projects. That's clearly lacking in the European Union.
And for permitting, the order is putting all of the lands under the federal mining code, so bypassing state-level mining codes. Do you think this will speed up permitting, or what would the impact be?
I mean, there are a couple of things. I mean, to make a comparison again with the CRMA, I think the US is using a same kind of approach as the EU now with the strategic project, because a couple of departments have now been mandated to identify pending projects, by which they can say, okay, we need to fast track these permitting approvals for these projects. A second thing is, the issue of federal lands. That's a big stumbling block in the US. So they try to, that's the aim, to streamline that and to mine more on federal lands. But again, given the litigation-prone nature of mining, that's easier said than done. And perhaps a bigger issue is the ESG angle here, which is lacking to some extent, because the US has, or the executive order mentions a couple of regulatory changes that they want to incentivize. And then again, some groups, some experts are saying, when it comes to these environmental, or given these environmental risks, social concerns, I mean, for instance, indigenous communities is not mentioned at all in the executive order. So that could again, lead to litigation, and also potentially will result in the fact that the administration will need to work with Congress to solve that as well.
You mentioned the ESG angle.
Yes.
And the ESG angle, I mean, we know what the Trump administration thinks of it. Europe is very, very much behind to have a strong ESG angle. And you also did some work on how to internalize the cost of ESG, or use it as a non-price criterion in the pricing of raw materials. What was your result so far on this? Do you think this is even possible?
So what is the question specifically?
If a non-price criterion based on ESG is possible in a global market like raw materials? I think you were alluding to our sustainability index. I mean, just to tell the listeners that sustainability has a according to our index, covers basically ESG. So it's a lot more than environmental considerations, but also social governance stuff and so forth. I mean, I think you're also touching upon more or less on green premium. And again, I mean, Florian, you know our view. I think unless, I mean, we don't see a premium or a green premium or sustainability premium emerging by market players paying voluntarily more above the market price, unless there are a couple of, let's say, policy interventions that incentivize this. Basically, rewarding green manufacturing, green manufacturers, battery makers that need basically green minerals for their supply chains. And I think the European Union is doing some stuff, is laying the groundwork for that. I mean, you're probably familiar with the carbon footprint requirements within the EU battery regulation. You've got a potential review of CBAM. You've got the strategic partnerships that try to incentivize sustainable prices. So, I mean, the EU is laying the groundwork, but it remains to be seen whether this will result in a green premium. So you think we are drifting apart, EU and the US, on the ESG angle? Because the Biden administration and the IRA, they were still very much focused on internalizing the ESG factor in their production methods.
Yeah, that's a good question. I mean, there is, obviously in the US, there is it's framed as an ESG backlash, which is now ongoing. To what extent has that resulted in the EU? I mean, the EU has now tabled a couple of initiatives that aim to streamline due diligence requirements, ESG requirements, which is, I think, to some extent a good thing. There is now, I think, a more pragmatic approach towards this. I mean, it's all about competitiveness right now. So I think they are trying now to cut red tape, especially for the smaller businesses. But nevertheless, I think it's especially compared to the US, I think the EU has still one of the highest ESG requirements, sustainability requirements, due diligence requirements worldwide. So I think that's something we need to keep in mind.
So ESG is also, and sustainability is also featuring very, very high in the Critical Raw Materials Act. We just saw the first list of projects published. What is your first take on that one?
I mean, first and foremost, I think it's a good step because we were waiting for a long time for this first set of projects. I mean, according to our numbers, one major takeaway is that the EU will lead basically non-European supply to meet the production targets in the CRMA. Although they're non-binding, I think politically they're quite important. Mm-hmm. Mining, processing, recycling, and the supply diversification targets. So with these projects alone, you will not get there. Apart from, I think, for lithium and nickel, we see that the 10% mining target individually for those minerals can be met to meet battery demand internally in Europe. But apart from those two, we don't see the other ones meeting the 10%, the 40% processing, and the 25% recycling target. So that brings me to the fact that these strategic partnerships with their countries, but also the projects that are going to be unveiled, I think, in the next couple of weeks, in non-EU countries will be pivotal, I think, to meet those targets. And it will also be challenging because, I mean, in a couple of countries, there are ESG challenges, of course.
So there is now a second list coming up of international projects under the Critical Raw Materials Act. What would you say about them?
Yeah, I think the second list is perhaps as important or even more important than the EU project because, as I said before, I mean, the EU will need foreign supply or non-European supply for a couple of minerals, especially cobalt, but also others, to meet the production and the supply diversification target, but in the end also demand for batteries and so forth internally. So those projects will be important. And again, the implementation of the strategic partnerships and future partnerships will be important. I mean, we talked about cobalt. Think about Canada. The EU-Canada relationship is very important. So that should also be a priority let's say, not only the project, but also the funding aspect of that and convincing investors to invest in those countries, in those projects.
You mentioned now investors. How do you think this first list of projects will impact investments into mining in Europe? Have you seen already some more interest of global equity to invest in Europe?
I want to just start with, again, saying that the market environment is still challenging. So that's, I think, always playing on the background. I mean, there is a low price environment. In some markets are oversupplied, although, again, as a company, we're quite we are bullish in the sense that towards 2030 we will see supply deficit. So you will need those projects. You will need more minerals. But on the investment side, I mean, more investments are needed. And I think, these strategic projects, in theory, they provide, if you got that label, easier access to finance. Also, the permitting, we talked about permitting in the US, but permitting in the EU is is really important as well. So streamlining that. So I think it gives a little bit confidence, but perhaps also more is needed again to convince investors to invest in Europe, especially in mining.
What's the most important factor to convince them? Is it the oversupply of certain markets? Is it the regulatory framework? Legal certainty?
I think it's everything. It's very holistic, but it starts with good mineral economics. I mean, your project must be profitable in a global context, and then we touch upon other suppliers, other actors like China. So I think it starts with the mineral economics. As long as your mineral economics are not good, that's where it starts basically, and then you need. It's a very holistic thing.
So how can we compete with such a behemoth in a market as China without a premium?
Again, looking at the high level numbers, China is very dominant, especially in the processing and in the downstream segment of the supply chain, not necessarily in mining. Besides graphite and rare earths. So it's also quite dependent on ore imports. So it's more looking at where are the Chinese investments in the strategic partnership countries, how to compete with that.
So we very often hear that the issue remains with the back end of the investment. So can it be then profitable if there is another player around that can easily flood the market with their products beneath the cost structure that we would have in European production? The role of China in the processing part is the bottleneck here. So where would we need to look also into international projects, how to get those projects competitive for European supply?
I mean, you're absolutely right. I think sometimes we underestimate. I mean, we say, okay, China is dominant across the supply chain, and to some extent that's true. But it's specifically true when it comes to processing and the downstream segment of the supply chain. Apart from graphite and rare earths, China is not that dominant in terms of mining. So in other words, they need to get the minerals from somewhere else. I mean, China has been doing this for decades or many years through a couple of strategic investments in areas like Africa. So it comes down basically, if you want a foreign supply and bankability and convince private investors is to some extent compete with those Chinese players in a couple of areas, mineral-rich areas, which is very hard, I think, because convincing those investments, basically de-risking the investments is quite key there. But I perhaps want to put a caveat into all this is, I've been talking to a couple of African experts that, I think incentivized or basically created a discussion about, why not to some extent work with Chinese companies? I mean, again, under the right conditions in some projects in Africa. I mean, working around ESG and so forth, because completely competing against China on cost, again, is quite difficult. I mean, I'm not saying that should be the rule number one and the guidance to do that, but why not, again, under certain conditions in terms of ownership, in terms of tech transfers and so forth. So my point is it shouldn't be excluded from the start if, the conditions and the environments are forcing you to do that.
You mentioned now de-risking of investments. We talked about funds and the streamlining of funds. So do we have the right tools at hand at the moment, or do we need more? More is or better.
Because that's, I think, an issue now also with the EU. I mean, the European Union is a behemoth of many departments. Many people are now, and actors are involved in terms of critical raw material policy. So there's to some extent a lack of coordination that is also being translated into the strategic partnerships, and perhaps a lack of investments in some of these partner countries. But that all, again, is related or comes down to a lack of a coordinated funding strategy, perhaps an industrial strategy around funding, because it's not that we don't have any funding. We've got a lot of funding mechanisms, but it's a question of centralizing the funding more, and at the same time using the right mechanism, perhaps new mechanism, innovative mechanism, to de-risk investments and to convince private sector people to invest in risky environments in Africa, like in the DRC. I mean, this can be done through, for instance, equity investments. I mean, we've got a lot of banks. We've got the EIB, Apparently, there's a critical raw material task force right now. I'm not sure whether they are considering this. And at the same time, something that comes up a lot now is price support mechanisms. Again, there's a little link again with the premium discussion that we had before. It's basically the idea that the government would come in and would pay or fund the difference between the market and a specific price floor or price ceiling. That can be tied into offtakes, that can be tied into volume, again, to provide the confidence and certainty to market players. Shouldn't forget, even in some markets in Africa, rare earths, graphite, where there are not many Chinese players involved in the mining, there are a lot of offtakes already tied to Chinese players.
Okay.
Again, that ties to in the question of processing, the dominance processing. So Europe should act fast. That means deploying perhaps the existing mechanisms in a better and more coordinated way, but also potentially looking at new innovative mechanisms to de-risk those investments.
And where would you see the role of national development banks or Exim banks that provide Euler Hermes guarantees and the like?
To some extent, they're already doing that, if I'm not mistaken. Germany has been doing that for years. The thing is, a couple of member states have been doing this. Sweden is often overlooked, but they've got like a very powerful export credit agency. Italy as well. But it's just about pooling this and have a coordinated approach. There is also politics behind this. I'm aware that every member state has national interest. But at the same time, if you want to have scale, if you want to compete with China, if you want to compete with the US, especially in areas like Africa, where you've got also a set of emerging actors coming up, you need scale. And you need pools and a coordinated funding mechanisms to do that.
So you see the EIB to have to play a more important role there?
They could, if they want to. Again, I've heard that there's a critical raw material task force right now. I think there is a 2 billion funding mechanism. I'm not sure whether that's only to focused on EU or also on non-EU countries. But I think those guys have a lot of experience, especially also the EBRD. They've got a lot of experience around equity investments in mining. I know is it unrealistic or not? I'm not sure, but those tools could help in terms of de-risking equity investment. Also, again, price support mechanism, off-take backstops. It comes down to just bring that confidence to private investment, private sector investment.
Another option that's always put forward, or that we hear very often, is the idea to pool demand.
Yes.
Of various sectors. Would this be a workable solution? How such a solution could work when we look into the real specification of
the issue is I've seen a lot of, you've got the joint purchasing platform that the EU has unveiled on paper. Now they are working on it. You've got like a critical raw material center that is now being tabled, announced. You've got like a battery raw material access center for, I think, automakers. So it's a lot of, that all, I think, sounds as pooling demand or helping suppliers with minerals. So again, that's confusing for me. That's one issue. More, I think, straightforward and aligned communication about this on what does that mean is really important, also for market players. On the other hand, one big issue is in terms of communication, they try to make the comparison between, we've launched a joint purchasing platform for gas, and now we want to do the same for critical minerals. Those are different markets. And you've got a lot of critical, I think, if I'm not mistaken, the joint purchasing platform only focuses on the strategic raw materials. There's a group of 17. There's a lot of markets. Some of them are quite opaque, are very volatile. There is a lack of understanding. So
the product has a lot of 1,000 different specifications. For
thousands of specific specifications, and you've got a lot of interest at play. I mean, also for the member states, aligning interests is difficult in every area in the European Union. So I think those are a couple of challenges. So I'm eager to see what will come out of this. And again, to what extent will that be linked to strategic stockpiling? And if not mistaken, strategic stockpiling is a national competence in the European Union. So it's again about aligning those interests. And I think the EU compares itself a lot with Japan, because Japan has been, I think, a front runner in terms of strategic stockpiling and so forth, but it's just one country. And a very national security imperative there. I mean, we talked about the US with national security imperative. I think the Japanese were there first with JOCMEC and other agencies that are focused on energy security. With the EU, you've got, it's how the EU works. I mean, it's a set of member states with different interests. So I think that could be a challenge.
So we will see what comes from it.
Yes.
Whether it would have an impact on the market and price.
I mean, the Commission is more than welcome to do an outreach. I think with our pricing analysis, we are able to help with the implementation.
Yeah, that's also a question that I actually wanted to ask you at the very beginning. How raw materials get their price defined?
Yeah, I think a big caveat in all of this, I'm not a pricing expert, so I will do my best to explain it. So as you, I think, rightly said in the introduction, we are a subscription-based intelligence provider, information provider, also data provider, focusing on a couple of clean energy supply chains, critical minerals, batteries, and EVs. But how Benchmark started in 2014 was as a price reporting agency, basically reporting on prices and try to benchmark the prices that are used in contracts. Because for a couple of minerals, like lithium, there is not a mature or an official market trading lithium. So I think, again, not the greatest expert, but I think that many of those prices are just negotiated in contracts. For instance, offtake agreements. So you need a benchmark price to do that. And so that's, I think, the foundation of Benchmark. It started as a price reporting agency, and then it grew into, let's say, an overall information provider holistically of all these supply chains, going from prices, demand, supply, geopolitics, and sustainability. So,
how do you cut through the opacity of some of those markets?
It's basically, how it works. Our pricing analysts are in direct contact with a set of stakeholders. So OEMs, traders, mining companies. I think everyone who is involved is, I think, we are in contact with everyone who is involved in, I would say, minerals, the pricing aspect of that. And based on that outreach, we do a benchmark. So it's it's not, I think, again, I'm not the greatest expert, but that's, I think, easily explains how we do that.
So we talked a lot about demand and supply in the pricing mechanism, but also then the geopolitical element.
Yes.
To what extent would you say the geopolitical element is defining the price of raw material?
I mean, in a sense, geopolitics, but also policy is now these days perhaps the biggest driver of one of the biggest drivers of the supply chain. To what extent that's I think translated to prices, that really depends on the supply chain, on the mineral. I think a good example is copper.
It's traded quite openly with the LME.
That's perhaps
let's go for a more obscure one.
An obscure one. I mean, I think cobalt to some extent is also traded in more opaque markets. I mean, it's a bit more mature than others, I think. But a good example is, for instance, the DRC announced an export ban on cobalt, a number of cobalt products coming from the DRC. So that has a major impact on prices because, again, cobalt prices were quite low. That had a major impact. And that's a nice example of how geopolitics is playing a role in the pricing aspect. But you're right, copper is more mature, but again, all these tariffs are having an impact on copper prices globally. So that's a nice example. I think it all comes down to political risk, what we're doing to some extent, and assessing those developments on the supply chain.
Thank you so much, Bryan, for being here. and for sharing your insights here. I think we can agree the three major elements that we have, or that we touched upon, are funding and investment. So we need better tools. We need to streamline our tools. We need to reach out more in the global markets, despite the US retreating and becoming more isolationist. And the last element, that geopolitics are really setting now the scene in the raw material sphere globally.
Yeah, thank you, Florian. I think those are good takeaways. I couldn't have done it better. And I mean, you told the audience that we're doing events. I think the next event that we'll be hosting is in Washington, D.C. And I think, without any doubt, I think politics and... Sorry?
You're going there?
I'm going to, yeah. I'm going to D.C. So I think there the US policy, but also geopolitics more in general, will be, again, front and center of that conference.
Excellent. Thank you.